Hi folks, welcome back to our channel. Today we'll continue the series of our educational videos and talk about buying a property in Canada, and in particular about an instrument called Home Buyer's Plan. It's a great tool that allows a lot of people to come up with the necessary down payment amount and buy their first home in Canada. By the end of this video, you will know the requirements that would qualify you for a home buyer's plan, what steps you need to take to participate in it, and some common misconceptions about this program. Let us know in the comments below if you have any questions or if you want to share your experience of using the home buyer's plan. Before we start, here's a little side note. All facts mentioned in this video are sourced from the official Government of Canada resources. We're not financial advisors and are speaking purely based on these facts and our own experiences. Alright, let's talk about buying a home. When you plan to buy a home in Canada, the first thing you need to think about is a down payment. A down payment is a percentage of purchase price of your home that you are required to put up front. The rest of the amount will be covered by a loan, commonly known as a mortgage. There are minimum requirements for a down payment amount depending on the total price. In Canada, they are divided into 3 tiers. If you're buying a home for up to $500,000, you are required to put the minimum amount of 5%. So for a $400,000 house, you are required to put $20,000 down payment. If the price is between $500,000 and $999,999, the down payment will be a calculation of 5% of the first $500,000 plus 10% of the exceeding amount. For example, for a property that you're buying for $700,000, you will be required to put a $45,000 down payment, which is a calculation of 5% for the first $500,000, that's your $25K, and the calculation of the difference, $700,000 minus $500,000, multiplied by 10%, and there's your additional $20,000, which brings the whole amount up to $45,000 of down payment. And if your purchase price exceeds $1 million, you will have to put a 20% down payment. So in this case, a $1.2 million house will require a $240,000 down payment. Please note that this information is valid if you are buying the property by yourself. If you do decide to buy with someone else, like say your partner, the numbers would be different, and we advise to discuss this particular situation with a financial advisor. Normally, the down payment amount should come from your own funds. It is recommended to put as many funds as you can towards the down payment, as it will impact your mortgage amount and hence decrease the amount you would have to repay later. It can save you thousands of dollars in the future interest payments. To help maximize your down payment amount, the Government of Canada has introduced a Home Buyer's Plan program. Don't confuse it with another program with a similar name, First Time Home Buyer's Incentive, where the government offers to put 5 or 10% of the home's purchase price towards the down payment. In our video today, we're talking about the Home Buyer's Plan. This program allows you to use the funds you have already saved up in your RRSP account, Registered Retirement Savings Plan, towards your down payment. Technically, you're borrowing this amount from your future pension and are required to repay it. The repayment starts on the 2nd year after you made a withdrawal and should be finalized within the 15 years period. For example, if you made a purchase in April 2022, you would receive a letter from CRA with your repayment plan at the beginning of 2024. And if you made your purchase in December 2022, you would still receive a letter from CRA at the beginning of 2024. So technically, if you want to have a longer grace period for your RRSP repayments, a purchase at the beginning of the year would make more sense to you. Of course, this shouldn't dictate your decision on such an important matter as purchasing a home. There are so many other factors that need to be considered. But still, it's worth mentioning. Regarding the amount that you can withdraw from RRSP, for the longest time it's been $25,000, but starting from March 2019, the borrowing amount has been increased to $35,000. You can withdraw it from several RRSP accounts that are in your name, with an exception of locked-in accounts and group plans. And if you're purchasing a home with a partner who also qualifies as a first-time home buyer, you can double that amount to $70,000. Mind you, in this case, the minimum requirement for the down payment, which we discussed earlier in this video, will change. If you decide to partner with someone for the purchase, we recommend discussing your particular situation with a financial advisor. The good thing about RRSP is that it is a tax-free account, which means a contribution to RRSP helps you lower your taxes, whereas withdrawal from RRSP, for example when you retire, is considered an income and you would have to pay taxes on that amount. But there's an exception. When you withdraw RRSP funds for the purposes of buying a home, you can use the full amount that you have saved up and not pay income taxes. Yes, you are required to repay it. And yes, the amount is limited, but it is still a great way to use the extra cash for your down payment. Now let's talk about eligibility requirements. You have to qualify as a first-time home buyer to participate in a home buyer's plan. To common misconception, this doesn't just mean that you've never bought a home before. This also means you can qualify as a first-time home buyer if in the last 4 years you haven't occupied the home that you or your spouse or common law partner owns. Let's say if you own a home, but you've been living in a rental apartment for at least 4 years, you can be considered a first-time home buyer. Another requirement is you must be a resident of Canada at the time of your RRSP withdrawal and at the time that you finalize your purchase. You must intend to occupy the home that you're purchasing as a place of your main residence for at least 1 year after the purchase. Now that you have determined your eligibility, there are certain steps that need to be taken. First of all, the purchase needs to be finalized. You can't just use home buyer's plan for a hypothetical purchase when you just started house hunting. Finding a home is a lengthy process and can sometimes take months or even years. So don't rush and make sure you have that perfect home on the hook before starting the paperwork for the home buyer's plan. Once the purchase is finalized and you are ready to withdraw money from your RRSP account, you need to fill out T1036 form, which is a home buyer's plan request to withdraw funds. This form can be found on the Government of Canada website and can be printed out or filled out in the editable PDF file. This form needs to be filled out for every RRSP account you're planning to withdraw from and signed with every financial institution you had your RRSP accounts with. The money in your account has to be there for at least 90 days before withdrawal, so be mindful of this. For example, if you're planning to come up with an additional amount of money, or someone is planning to gift you a certain amount of money towards your down payment, don't just put it into RRSP for tax purposes if you need to make a home buyer's plan in less than 90 days. In this case, it's better to put this extra amount into your checking account. Be mindful of timing. You need to withdraw all home buyer's plan amounts in 1 calendar year, because you would need to claim the full amount for tax purposes next year. When you submit your form T1036, this will automatically sell your assets in your RRSP accounts at a market price. It's important to consider this and keep an eye on current market situation before your purchase. Once withdrawn, the money will land on your checking account and it can be used towards your down payment together with other funds that you have prepared. Congratulations! By this time, everything should go smoothly and you will soon become a happy owner of your first home. When you file taxes for the year you purchased your home buyer's plan RRSP withdrawal will not count towards your income and hence will not be taxable. In the second year after purchase, you will have to start repaying the borrowed amount. You will be able to find your repayment schedule in My Account on CRA website, and you will also be provided with an annual statement of account. CRA gives you 15 years period to do it and divides the amount owed into 15 equal payments per year. For example, you borrowed $30,000 from your RRSP account, which means that you will need to be paying $2,000 each year to reimburse this amount. You can start repaying it earlier, but this grace period is a nice benefit that will allow you to understand your new budget as a homeowner and organize your personal finances better. The equal amount is the minimum payment you are supposed to make each year. You can choose to pay more than that, and it will help you reduce your home buyer's plan balance faster. If you don't pay your minimum balance, you will have to specify the amount you owe this year on your annual tax return. For example, if your annual repayment amount is $1,000, but you only managed to pay $200, you will have to specify the difference of $800 on line 129, and you will be taxed for this amount. Kind of defeats the purpose for tax-free withdrawal, but there's different circumstances that might require this measure. And it's nice to know that you have an option. And this sums up our overview of the home buyers plan offered by the Government of Canada that allows you to use your RRSP towards a down payment for your home. We hope this video helped you get a better understanding of this program and its benefits and hidden tricks that might be beneficial to you. If you liked this video, please give us a shout in the comments below, smash that like button, and subscribe to our channel for more videos like this. Till next time.